Question 1. Which of the following is a key difference between short-term and long-term disability insurance? A short-term disability insurance covers a longer period than long-term disability insurance. B. Long-term disability insurance typically offers higher benefit amounts than short-term disability insurance. C. Short-term disability insurance has a longer elimination period than long-term disability insurance. D. Long-term disability insurance generally has a waiting period of 24 months or longer. Answer: B. Explanation: short-term disability insurance (STD) typically provides benefits for a shorter duration, usually 3 to 6 months, and has a shorter elimination period, typically 7 to 14 days. In contrast, long-term disability insurance offers benefits for extended periods, ranging from several months to a lifetime, and usually has higher benefit amounts, often up to 6070% of the insured's salary. The waiting or elimination period for LTD is longer, ranging from 30 to 180 days, depending on the policy. While both policies are designed to replace lost income due to illness or injury, LTD insurance often covers more significant long-term disabilities and has higher benefit caps. Question 2. Mr. Thomas is a self-employed professional with a medical condition that he believes will cause him to be unable to work for several months. He is considering purchasing a disability insurance policy. Which of the following factors should Mr. Thomas consider when choosing between a long-term disability insurance plan and a short-term disability insurance plan? A. He should choose a short-term policy because the elimination period is shorter. B. He should choose a long-term policy because it will cover him for a longer period if his disability extends beyond a few months. C. He should opt for a short-term policy because it will provide a larger benefit payout per month. D. He should choose a long-term policy because it has a higher waiting period, which aligns better with his financial planning goals. Answer: B. Explanation: Mr. Thomas should opt for a long-term disability insurance policy if he anticipates that his disability could extend beyond a few months. Long-term disability policies provide coverage for extended periods, often until age 65 or for the duration of the disability, whereas short-term disability typically provides coverage for a few months, which may not be sufficient for his anticipated needs. While short-term disability has a shorter elimination period, long-term disability will ultimately offer better protection if the disability persists. The key consideration here is the duration of coverage as well as the monthly benefit amounts and waiting periods. The benefit amounts for long-term disability are usually lower but designed for longer-term coverage. Question 3. Which of the following is typically excluded from coverage under most disability insurance policies? A. Chronic back pain. B. Disabilities arising from an accident during a car crash. C. Disabilities related to substance abuse. D. Disabilities related to a broken limb. Answer: C. Explanation. Many disability insurance policies exclude coverage for disabilities related to substance abuse. This is a common exclusion found in both short-term and long-term disability policies. Chronic conditions such as back pain or a broken limb are generally covered as they fall under typical disability scenarios. Disabilities arising from accidents, such as those resulting from a car crash, are also usually covered unless there is an exclusion for specific activities or pre-existing conditions. Substance abuse is considered a behavioral health issue, and most insurers exclude claims related to alcohol or drug dependency, even if it results in a long-term disability. The reasoning behind this exclusion is to avoid incentivizing moral hazard or claims resulting from avoidable conditions. Question 4. Which of the following is a typical benefit calculation for long-term disability insurance? A. 100% of the policyholder's pre-disability income. B. 60% to 80% of the policyholder's pre-disability income, subject to policy limits. C. A fixed amount determined by the insurer regardless of the policyholder's income. D. 50% of the policyholder's income for the first 6 months, then 75% after that. Answer: B. Explanation. Most long-term disability insurance policies provide benefits that replace a portion of the policyholder's pre-disability income, typically between 60% and 80%. This percentage is subject to the terms of the policy, and benefits may be capped at a certain dollar amount to prevent overpayment. The goal is to offer enough income replacement to cover living expenses while keeping the insurer's liability manageable. Offering 100% of pre-disability income is rare, as insurers aim to avoid creating a financial incentive to remain disabled. This percentage also reflects the reality that disability benefits are often taxed, meaning the insured will net a lower amount than the policy benefit. Question 5. Under what condition would a disability insurance policy most likely refuse to pay benefits due to a pre-existing condition? Cause: A, if the disability occurs after the first 30 days of the policy. B, if the disability is caused by an accident that occurred before the policy's inception. C, if the disability occurs within a specified period after the policy's start date, usually within 12 months. D, if the policyholder has been diagnosed with a mental illness before the policy's start date. Answer: C. Explanation. Most disability insurance policies include a pre-existing condition clause that typically excludes coverage for disabilities arising from conditions diagnosed or treated within a specific period before the policy's effective date, usually 12 to 24 months. If a disability arises from a pre-existing condition within this exclusion period, the insurer will usually refuse to pay benefits. However, once the exclusion period passes, the pre-existing condition clause no longer applies. The policy may also include provisions that allow for the exclusion of mental health conditions, but this is separate from the pre-existing condition rule. Question 6. A policyholder has been receiving long-term disability benefits for 6 months. The policy states that after 24 months, benefits will be reduced if the policyholder is capable of performing any occupation. Which type of disability coverage is described in this scenario? A. Own occupation coverage. B. Any occupation coverage. C. Partial disability coverage. D. Social Security Disability Insurance (SSDI) coverage. Answer: B. Explanation. The scenario describes any occupation coverage, which means that after a specified period, often 24 months, benefits are reduced or terminated if the policyholder is able to work in any occupation, not just their prior job. This contrasts with own occupation coverage, which provides benefits for a disability that prevents the insured from performing their own job regardless of their ability to perform other types of work. This limitation is commonly used in long-term disability policies to reduce the insurer's exposure once the insured has received benefits for an extended period. Question 7. Which of the following best describes the role of the elimination period in a disability insurance policy? A. It's the period after disability occurs during which the insurer does not pay benefits. B. It's the period before the policyholder must apply for benefits. C. It's the waiting period between the onset of disability and the policyholder's return to work. D. It's the maximum duration the policy will cover any one claim. Answer A. Explanation. The elimination period, also known as the waiting period, is the period after disability occurs during which the insured is not eligible for benefits. This period typically ranges from 30 to 180 days, depending on the terms of the policy. The purpose of the elimination period is to ensure that the disability is sufficiently serious and long-term before the insurer begins paying benefits. This period also helps to reduce administrative costs and prevent the payment of small, temporary claims. Once the elimination period is over, benefits typically begin and the insured is eligible to receive monthly payments. Question 8. Which of the following is generally excluded from coverage under most disability insurance policies? A. Injuries from participating in sports-related activities. B. Injuries sustained during routine commuting to work. C. Disabilities caused by pre-existing conditions that are disclosed to the insurer. D. Injuries resulting from accidental falls at home. Answer A. Explanation. In most disability insurance policies, injuries sustained while engaging in risky or sports-related activities are commonly excluded. This is because insurers classify these activities as high risk and thus may not want to cover injuries that occur during such events. Some policies may offer coverage for injuries sustained during accidents while commuting to and from work, depending on the jurisdiction and policy specifics. Pre-existing conditions may also be excluded if they were not disclosed and fall within the exclusion period. Accidental falls at home are typically covered unless the injury is specifically excluded by the policy. Question 9. What is a primary advantage of disability insurance for self-employed individuals compared to traditional employees? A. Self-employed individuals can receive higher benefits because they have no employer to contribute. B. Self-employed individuals can structure their disability insurance to cover multiple income streams. C. Self-employed individuals have no waiting period to qualify for benefits. D. Self-employed individuals are not required to pay premiums for disability insurance. Answer B. Explanation. Self-employed individuals benefit from disability insurance because they can customize their coverage to protect their unique income streams, including profits, fees, and other business-related earnings. unlike traditional employees whose disability benefits are based on a salaried income. Self-employed individuals often have more diverse sources of income that need to be covered. Disability insurance policies for self-employed individuals can be structured to account for this by including business income and personal income, allowing for a more comprehensive coverage. Additionally, self-employed individuals must purchase their own insurance and typically face higher premiums than employees who receive employer-sponsored coverage. Question 10. Which of the following disability insurance riders would increase the policy's benefit if the cost of living rises during the term of the policy? A. Future increase option rider. B. Cost of living adjustment COLA rider. C. Non-cancelable rider. D. Catastrophic disability rider. Answer. B. Explanation. The cost of living adjustment COLA rider is designed to increase the disability insurance benefit over time to keep pace with inflation. This rider is crucial for long-term disability policies because the purchasing power of the original benefit amount may decline as the cost of living rises. The COLA rider automatically adjusts the monthly benefit based on a set inflation rate or a consumer price index. The future increase option rider allows the policyholder to increase coverage at specific intervals without medical underwriting, but it does not directly address inflation. The non-cancelable rider guarantees that the insurer cannot cancel the policy, while the catastrophic disability rider provides additional coverage in the event of severe disability. Question 11. Which of the following is a common feature of a waiting period or elimination period in disability insurance policies? A. It is the period during which the policyholder must wait to file a claim. B. It is the waiting time before benefits begin after disability is reported. C. It is the maximum period the policy will pay benefits. D. It is the duration that the insurer has to process a claim. Answer. B. Explanation. The elimination period, or waiting period, is the time between the onset of the disability and when benefits begin to be paid. This period is typically set by the policyholder and can range from 30 to 180 days. The purpose of the waiting period is to reduce claims for short-term illnesses or injuries that do not result in long-term disability. It also helps the insurer limit their exposure to claims for minor injuries or illnesses. Question 12. Which of the following best describes own occupation disability coverage? A. It provides benefits if the insured cannot perform their regular job or any other work. B. It provides benefits only if the insured is totally disabled from working in any occupation. C. It covers disabilities caused by illness, but not injury. D. It provides benefits for a specified number of weeks if the insured is temporarily unable to work. Answer A. Explanation. Own occupation disability coverage provides benefits to policyholders if they are unable to perform their specific occupation duties, even if they could work in another job. This type of coverage is more favorable to policyholders as it ensures that they receive benefits if they can no longer perform the work they were trained or specialized in, regardless of their ability to work in a different field. Question 13. Which of the following is a typical exclusion in a disability insurance policy? A. Disabilities resulting from participation in high-risk sports or activities. B. Disabilities caused by accidents at work. C. Disabilities resulting from non-routine commuting. D. Disabilities caused by automobile accidents. Answer A. Explanation. Many disability insurance policies exclude coverage for disabilities that result from high-risk activities such as skydiving, rock climbing, or other extreme sports. These activities are considered higher risk, and insurers typically avoid covering injuries associated with them. Other exclusions may include pre-existing conditions, self-inflicted injuries, or substance abuse-related disabilities, depending on the terms of the policy. Question 14. Which rider on a disability insurance policy would allow the policyholder to increase their coverage in the future without additional medical underwriting? A. Waiver of premium rider. B. Future increase option rider. C. Cost of living adjustment COLA rider. D. Catastrophic disability rider. Correct answer. B. Explanation. The future increase option rider allows the policyholder to increase their disability insurance coverage at specified intervals without needing to provide medical evidence. This rider is helpful for individuals who expect their income to rise over time and want to ensure their disability benefits will keep up with their earning potential. Question 15. If a policyholder has both short-term and long-term disability insurance, which of the following is true regarding coordination of benefits? A. Short-term disability benefits are paid first, followed by long-term disability benefits. B. Long-term disability benefits are always paid first, regardless of the circumstances. C. The policyholder must choose whether to claim short-term or long-term disability benefits. D. Short-term and long-term disability benefits cannot be paid concurrently under any circumstances. Answer A. Explanation. When a policyholder has both short-term and long-term disability insurance, short-term disability benefits are usually paid first, covering the period between the onset of the disability and when long-term benefits start. The long-term disability benefits will then begin once the short-term disability coverage ends or after the elimination period. However, short-term disability benefits may be integrated with long-term benefits if the total payments exceed the insured's income. Question 16. Which of the following is typically true from any occupation disability coverage? A. It provides benefits if the policyholder cannot perform their regular occupation. B. It provides benefits if the policyholder cannot perform any occupation, even if it is not related to their current job. C. It is more expensive than own occupation coverage. D. It provides benefits only if the policyholder cannot engage in any income-generating activity. Answer B. Explanation. Any occupation disability coverage provides benefits if the insured is unable to perform any occupation for which they are reasonably qualified based on their training, education, or experience. This type of coverage is typically less expensive than own occupation coverage, but offers less favorable protection because it requires the policyholder to be totally disabled from any form of employment, not just their current job. Question 17. The policyholder purchases a disability insurance policy with a 90-day elimination period. If the policyholder becomes disabled on day 30 of the policy, when will benefits begin? A. After 60 days. B. After 90 days. C. Immediately upon disability. D. After the first 30 days, with a 60-day waiting period for benefits. Answer B. Explanation. The elimination period is the waiting period before benefits begin. In this case, the policyholder has a 90-day elimination period. Regardless of when the disability occurs, benefits would begin after 90 days from the date of the disability. The first 90 days, known as the elimination period, are essentially the insured's responsibility to cover, typically through savings or other income. Question 18. Which of the following would typically trigger the payment of disability insurance benefits under an individual policy? A. Hospitalization for a chronic illness. B. Inability to perform normal job duties due to an injury or illness. C. A temporary job loss not due to illness or injury. D. Retirement at age 65. Answer B. Explanation. Disability insurance benefits are typically triggered when the policyholder becomes unable to perform their normal job duties due to injury or illness. The key factor is the insured's inability to work as a result of the condition, not necessarily the duration of the condition. Hospitalization or temporary job loss alone would not qualify unless they prevent the policyholder from working. Retirement does not qualify for disability benefits, as they are meant for those who are unable to work due to a disability. Question 19. Which of the following is a common feature of a group disability insurance plan? A. Benefits are paid based on the individual's specific medical history. B. Coverage is often provided with no medical underwriting. C. Policies are typically customized to meet individual needs. D. Benefits are paid regardless of employment status. Answer B. Explanation. Group disability insurance plans often do not require medical underwriting, which means that coverage is typically provided without the need for a medical exam or detailed health history. This makes group plans more accessible, but it also means that coverage may be less tailored to the individual's needs compared to individual policies. These plans are usually offered through employers or organizations and may have less comprehensive coverage than individual policies. Question 20. What type of disability insurance policy typically provides coverage for employees in the event they are unable to perform their job due to illness or injury? A. Accidental death and dismemberment insurance, ADI. B. Short-term disability insurance, STD. C. Workers' compensation insurance. D. Long-term disability insurance, LTD. Answer B. Explanation. Short-term disability STD insurance provides benefits to employees who are temporarily unable to work due to illness or injury. STD benefits are typically paid for a short period, usually up to 6 months, and can replace a portion of the employee's lost income during that time. Long-term disability (LD) provides benefits for longer periods, but only kicks in after the short-term coverage ends. Accidental death and dismemberment (AD) insurance and workers' compensation insurance have different purposes and are not typically used for covering short-term disabilities. Question 21. Which of the following best describes the presumptive disability provision in a disability insurance policy? A. It allows the insured to be eligible for benefits if they cannot perform any occupation. B. It states that certain conditions automatically qualify the insured for benefits, regardless of their ability to work. C. It provides benefits only for mental illnesses. D. It is a rider that accelerates benefits based on the severity of the injury. Answer. B. Explanation. The presumptive disability provision provides that certain severe conditions, such as the loss of sight, hearing, or limbs, automatically qualify the insured for disability benefits. These conditions are presumed to be disabling, and the policyholder does not need to prove they cannot work in their occupation to begin receiving benefits. Question 22. What is the primary purpose of the rehabilitation rider in a disability insurance policy? A. To pay for the insured's medical treatment during a disability. B. To provide benefits if the insured is unable to work due to a mental illness. C. To cover the cost of physical therapy or vocational retraining to help the insured return to work. D. To offer additional benefits if the insured's disability lasts longer than 2 years. Answer. C. Explanation. The rehabilitation rider helps cover the costs of vocational rehabilitation or physical therapy to assist the insured in returning to work. This may include retraining for a new career if the individual is no longer able to perform their previous occupation due to disability. The rider is designed to speed up the recovery process and get the insured back to work as soon as possible. Question 23. What does the cost of living adjustment (COLA) rider do in a disability insurance policy? A. It provides additional coverage if the insured's disability is caused by an accident. B. It increases the benefit amount each year based on inflation or a specified percentage. C. It offers a lump sum payment if the insured's disability lasts more than a year. D. It ensures benefits are adjusted for changes in the insured's employment status. Answer. B. Explanation. The cost of living adjustment (COLA) rider ensures that disability benefits keep pace with inflation. Each year, the benefit amount increases by a fixed percentage, e.g., 3%, or in line with an inflation index, which helps to maintain the purchasing power of the policyholder's benefits over time. This rider is particularly useful for long-term disabilities. Question 24. Under a disability insurance policy, partial disability benefits are typically paid when A. The insured can no longer perform any of their job duties. B. The insured is still able to work, but in a reduced capacity or with restrictions. C. The insured is totally unable to work, but only for a short duration. D. The insured returns to work after long-term disability, but in a lower-paying job. Answer. B. Explanation. Partial disability benefits are designed for individuals who cannot perform some but not all of their job duties. These benefits are typically paid if the insured is still able to work in a reduced capacity or with restrictions, but their ability to earn an income is significantly impaired. The insured may receive a portion of their disability benefits during this time. Question 25. Which of the following is a typical characteristic of group disability insurance plans compared to individual disability policies? A. Group disability insurance typically provides higher benefit amounts than individual policies. B. Group disability insurance is usually more expensive due to medical underwriting. C. Group disability insurance benefits are often taxable to the employee. D. Group disability insurance is generally available only to individuals with high-risk occupations. Answer. C. Explanation. In group disability insurance plans, the employer often pays the premium and the benefits are typically taxable to the employee. This is because the premiums are paid with pre-tax dollars, and the IRS treats disability benefits as income when they are received. In contrast, benefits from an individual policy are often tax-free if the policyholder paid the premiums with after-tax dollars. Question 26. Which of the following is an example of a non-cancelable disability insurance policy? A. A policy that can be cancelled by the insurer at any time after the first year. B. A policy where the insurer cannot increase premiums but can cancel coverage. C. A policy that guarantees renewal, but premiums can be increased based on age. D. A policy that the insurer cannot cancel or alter terms until a specified age, even if health changes. Answer: D. Explanation. A non-cancelable disability insurance policy is one where the insurer cannot cancel the policy or change the terms, including premiums, until a specified age, even if the insured's health changes. This type of policy provides greater stability and security, ensuring the insured cannot lose coverage due to changes in their health status. Question 27. What is the primary difference between short-term and long-term disability insurance? A. Short-term disability insurance covers more severe disabilities, while long-term disability covers less serious injuries. B. Short-term disability insurance typically covers up to 2 years of disability, while long-term disability provides benefits for longer periods. C. Short-term disability insurance provides a low benefit percentage, while long-term disability insurance provides a higher benefit. D. Short-term disability insurance typically provides coverage for up to 6 months or a year, while long-term disability insurance can last for years or until retirement. Answer: D. Explanation. Short-term disability insurance typically covers a short duration of disability, often up to 6 months or a year, and provides a percentage of the insured's income during that period. Long-term disability insurance, on the other hand, covers longer durations, often lasting for years or until the insured reaches retirement age, depending on the policy. Question 28. If an individual becomes disabled but is able to work in a different capacity, which of the following provisions might allow them to receive partial benefits under their disability insurance policy? A. Rehabilitation benefits. B. Subrogation provision. C. Residual disability benefits. D. Recurrent disability provision. Answer: C. Explanation. Residual disability benefits are designed for individuals who cannot perform all of their job duties due to disability but are still able to work in a reduced capacity. This provision provides partial benefits to compensate for the lost income resulting from the disability, even if the person is still able to work part-time or in a different role. Question 29. Which of the following is most likely to be excluded from disability insurance coverage? A. Disabilities caused by participation in competitive sports. B. Disabilities caused by accidents at work. C. Disabilities resulting from medical treatments. D. Disabilities caused by chronic medical conditions that worsen over time. Answer: A. Explanation. Disabilities caused by participation in competitive or high-risk sports, such as extreme sports, are often excluded from coverage in disability insurance policies. These activities are considered high risk and may be specifically excluded in the policy terms. However, most policies will cover disabilities resulting from accidents at work, medical treatments, or chronic conditions, depending on the terms. Question 30. In a disability insurance policy, what does a disability income replacement refer to? A. The total replacement of all lost income due to disability. B. A partial replacement of income, typically around 60–70% of the pre-disability earnings. C. A lump sum payment to the insured after a disability claim is filed. D. A tax-free income that is provided for the duration of the insured's disability. Answer: B. Explanation. Disability income replacement typically replaces a portion of the insured's income, often around 60–70%, based on pre-disability earnings. This is done to provide financial support during the period the insured is unable to work due to a disability. While the percentage may vary depending on the policy, it is not a full replacement of income to account for factors like other sources of income or benefits.